Clearview Energy Partners looks at macro energy trends for institutional investors and corporate strategists and leaders. A combination of essentially a negative demand shock from the coronavirus and a positive supply shock from flat-out oil war, or at least the declaration thereof. These are not normal times.
But the structure of the industry means that you can't wind down output that quickly.
Yeah, the logic is pretty simple. If you look back at the last time we had a price break, start with July of 2014. It took about 4 months for the rigs to stop drilling. So you really had a much slower slowdown then than I think you'll see this time. They're already stopping. But then it took 9 months for the overall production from tight oil and shale to inflect to the downside. And part of the reason was, of course, that the wells take a while to decline. They decline fast, but they were starting fresh and hot. This time, too, that might be faster. There's a couple other interesting statistics, too. It takes people, of course, to frack. And so you might get a quicker shutdown this time around if people aren't going out to rigs because they're staying home for safety reasons. Corporate cultures, as you know, in the oil and gas industry, very focused on safety and tend to emphasize it sometimes even to their own detriment. In this case, tightening supply might not be to their detriment. It might actually be to their benefit. But look, if you think about what you've got on the Russian side, you've got a tax regime that insulates producers as prices fall and encourages greater production. That's the mechanism that underlies their willingness to go to battle in response. And as far as the Saudis go, you know, you can talk all you want about the cheapest barrel here, the cheapest barrel there. They live to the cheapest barrel. And what is a fiscal break-even? What is an external break-even? Those are numbers that economists use. What numbers do leaders use? They look much more at the reserves, the cash in the bank. And so the Saudis are fairly flush and can go the distance. In other words, I don't think there's a lot of reason to expect there to be much blinking soon. You have the Emiratis, the Nigerians, and other players saying they're going to step it up as well. So we're looking very much right now at a race to the bottom if everyone keeps faith. One thing I'll add, though, is as those prices fall, you will start to get shut-ins in some places. No, probably not in the U.S. shale patch because they'll run them until they stall. But in a lot of the other producing areas, when you fall below the marginal break-evens, you might see some shut-ins. It's fairly clear at this point that President Trump is not in a hurry to raise gasoline prices and to do it certainly by any of the proposals that have been bandied about. There's a lot of questions about interventions that the U.S. government might take to constrain supply somewhere else. As long as the president keeps looking at the marginal voter in the Rust Belt as his path to re-election, there isn't a lot of political upside in doing anything to raise pump prices. The bigger questions may have to do with the other parts of the market basket besides gasoline, but no one's going to thank the president for raising gasoline prices. In an ordinary world, the market begins to clear and balance. There's a place in time where the price of oil is low enough that the producers capitulate. Ownership changes with either a bankruptcy or more likely an acquisition and consolidation. In this particular case, because you have this artificial, or not artificial, I suppose, very natural but unfortunate constraint on demand from the coronavirus, the market doesn't have the ability to necessarily respond in a way that signals that it's a good time to put more money into the shale patch. There's already capital discipline everywhere, private equity losing patience, investors running from the sector. This is not going to be a time where a lot of these firms are going to be able to source capital.
Say 2 years from now, we'll be looking back at the oil market. What do you think is going to happen to the global crude market?
I believe in the human spirit and innovation. I think we'll be back to a world of trade and growth, but probably not as much. One of the things to think about is that the de-globalization wave is probably going to be hastened by the coronavirus. A lot of value chains are coming home, and a lot of producers of non-energy goods concerned about being able to source supply from overseas. What that means in de-globalization in the long run is inefficiency, but in the short run, it means an incremental energy supply required to build more stuff in more countries. So there's a short pop probably coming to the upside on the economic recovery from where we are today. In the years that follow, my crystal ball doesn't go that far.